So let's get started. I think purpose यही था इस session का. Firstly, we did our first webinar, I think 3 months back. Uh, at that point of time, we had around I think 5 to 10 people in Smile family. And now we have grown up, I think, up to around 60 people, right, out there. So it's a good achievement. I mean, would not happen, I think, without you guys' support, right? So uh, really appreciate all the love and support here. Uh, right now, I think one thing that in the previous session that we did, we basically did a basic walkthrough of what Smile is, how we basically usually invest, what is our investing style. But now that more people have joined in, somewhere we thought that it is good to connect once and tell them that this is how we basically pick or select certain stocks, what criteria we decide currently. So all these things basically become very important for someone who has no idea about why we have picked certain stock with the right reasoning, right? They can basically relate to the same thought process that we have. So that is one thing. The second thing that we thought that even if you know that okay, these are the stocks that we have to invest, but uh, by the way, all of you are comfortable with English, or any one of you would prefer to speak in Hindi? So just let me know. Anyone who says that is only preferring Hindi, then I'll speak in Hindi, no Hindi only, right? Okay. Nevertheless, right? So I think we are good. So the second thing was that okay, you know about the right stock, then how much how should we basically deploy money in that, right? Because there are 50 odd stocks out there, right? And then market sometime is at all time high, sometime market is low. So at what point of time, how much cash we have to deploy, that is second problem. And then third problem is that people who are already sitting on profits, what is the right profit booking strategy, right? That again is an important part that even most experienced investors are not able to get it right. uh, so very quickly, our background, right? Will the agenda is to basically talk quickly about the background, right, and then we'll speak about the investing process that Smile follows. We'll talk about the cash deploying strategies in more detail, right, which again is a very important discussion to have. The profit booking approaches that we follow here, and then the undervalued themes and stocks side that we have. The past learnings are very important as well, right? Until you know that, okay, you reflect, you basically gave certain recommendations in the past. So where are they respect to now? Again, it's very important, right? So we give a lot of importance to the past learnings. It's not that, we are every time coming and suggesting you stocks to buy, and then we are not looking at stocks which did not, perform in the past, right? So it's very important to basically look at your past track record. Uh, background, I mean, yeah, Smile is a journey started by me and Shweta. Shweta is a chartered accountant with 12 years experience. Unfortunately, she could not join today's call. And I am by profession a software engineer, a principal software architect in a well-known organization with 14 years experience. Personally, in stock market, I specifically have around 10-15 years of experience. Like, and even beyond that, I've seen markets working, right? Like so there are all different things that I've seen in market, right? The bull runs, bear runs, the consolidation phases, right? When nothing is happening. But all in all, I think it's always good to be part of stock market, right? We'll talk about that more. And yes, last time that we met, we were not SEBI registered 3 months back, but now we are SEBI registered, right? So Shweta is a SEBI registered research analyst, right? So uh, now we are officially, entitled to provide stock market recommendations, but there are certain compliance and norms that we have to follow, right? So we try to little bit, compliant in that manner. Very quickly, SMILE is, it's an acronym developed, by us only, like stock market investment, learning, and education. And then the Smile Investing Advisory, if it's a follow up on that. So why Smile? Because we try to provide you quality research that almost even today big institutions or DIs or FIs try to do, right? So we have developed our own financial models, with uh, a lot of back testing of historical data to understand what works in market and what doesn't work in market, right? We have generated a pretty good CAGR, well over 40%, 50%, right, over the last 2 3 years. Uh, Even before that, we have had good run up, but market has been very kind. Let's be honest about certain things that the CAGR has to do with a lot to do with the markets than us specifically. But yes, we a combination of market basically environment and the stock selection that we do. It's a combination that ends up with a good CAGR, right? So it's important. And then yes, we have a reasonable pricing, right? Because if you look at uh, market options, right? Someone who is doing a quality research and doing, generating good CAGR is going to charge you, probably over 25,000, 30,000, 50,000, right? That is what the SEBI registered research analyst charges, right? So we wanted to basically bring some disruption in a manner that we wanted to offer very affordable pricing, so that people can get this research at a reasonable pricing. And in future also, we don't plan to increase this pricing significantly. So just try to keep in balance with what market trends are. We have a pretty optimal risk reward strategy. We'll talk about that, how that works. And then we try to focus on consistent profit booking, because the the profit that is kept in paper, I mean, eventually whatever profits you have gained in bull market, the bear market will try to snatch away that, right? Probably 70%, 80% of that. So it's okay, to book consistent profit booking, do consistent profit booking, and not be greedy about, right, the profit that you have. And last but not the least, we wanted to ensure that it's a strong, close knit group, where we have a solid connectivity, where people can, the people are always informed about the recent updates happening in market, right? Uh, and Because what happens is that like if you look at other research advisory firms or maybe mutual funds or other things, right? You get to know about the stocks, and then sometimes the correction happen. You don't know, right? Why my stocks are falling. What should I do? Should I panic more? So the strong connectivity one is very important. On WhatsApp group, we try to keep you guys, as you would have seen also, right? On a daily basis and a weekly basis, we try to provide outlook and keep you calm, keep you composed. Even during election time, we saw a lot of volatility, right? So the idea is to always tell you guys that it is. Let's not be worried about, right, all the fluctuations or volatility happening in the market, right? Sorry, it's a hand raised from Nitin. Nitin, you want to ask something, or it was by mistake? Okay, nevertheless, I know. Yeah, and it's a very quick, formula that I picked from the Thoughtful Investor book by Basan Maheshwari, right? Uh, what it tells you is that with a certain CAGR, right, how much year will it take you, to get a certain multiplier in market, right? For example, let's look at the most common multiplier, which is 26%, right, or 25% CAGR. So with this kind of multiplier in 3 years, you get your money, twice, uh, and in 10 years, you get your money 10 times, right? So a 20 to 25% CAGR is a pretty good, uh, uh, CAGR, right? You should not try to be too greedy, right, in market. Uh, if you want to basically achieve more than this particular CAGR, like try to go with 30%, 40%, right? So the multiplier is like, in the multiplier shifts you by an year, right? For example, for 40%, your money gets double in 2 years, right, rather than 3 years. And you get your money 10 times in 7 years, right? With 25%, it was 10 years, right? And in 10 years, with 40%, you get it 28 times. Now, there are a lot of people, right, on social media, influencers, they talk about generating 20-25% CAGR, but practically, the journey is never linear, right? Like the market is not going to give you consistent 20%, 25% CAGR every year. What likely will happen is that, say, beginning from now, like market is at top, it may happen that, market corrects by 20%, maybe 30%. Then another year, right, you see 10%, 15% run up, right? Or maybe the correction continues by 10 15%. Then probably the third year you see 70 80% or even 100% upside. Maybe the other year you see 50% upside, and then again 20% correction, 30% correction, or maybe a severe crash also comes sometimes, probably at 50%. So But overall, holistically, if you look at the index level, right, like you look at the Nifty small cap indexes, right, Nifty mid cap indexes, they are generating well easily enough, around 20% CAGR if you look on a period of 10 years or so, right? And Nifty itself is generating around 22, oh sorry, 12 to 13 or 12 to 15% CAGR, right? Uh, on a last 10-year, 20-year basis, if you analyze that data. So our idea is basically to not be greedy, but define a well structured process where we can try somewhere between at least just 20-25% CAGR up till 40% or more, right? So if we get our process right, we may end up generating more as well, right? But all we basically need to ensure is that try to be disciplined and follow our process consistently. So we'll talk more about process soon. Let's go to the next slide. Uh, Now, this is very important, right? This summarizes the overall process that we have. It's a very simple process, but it's still pretty difficult to follow, right? At times, like the very first step is to the very first step that we identify is follow or identify what are the overall undervalued themes, right? The ignored themes or sectors, right? Which is completely ignored by the market right now. Like for example, if right now market is talking a lot about railway stocks, the hot stocks, right? So we never try to focus too much on the hot stocks. We believe that try to establish your positions in the undervalued themes, and then wait for these undervalued themes to eventually become hot at some point of time in 2 years, 3 years, 5 years, right? So hot sectors are those where we are historically invested and where we should be trying to look profits, right? Do profit booking rather than looking at fresh investments. It is the undervalued themes where we should be looking at fresh investments. Now you would think that even if market is at all time high, are there really some themes which are undervalued? So we'll talk about that. Like right now, there are around 80 to 90, I think, sectors out there, and at an industry level, there are around 130, 140 sub-industries, right, which are there in the market. All we think that there are just 10 top level sectors out there: infra, pharma, FMCG, construction, and whatnot, right? So at a high level, there are only 10, 12, sectors. I was trying to explain this particular smile stock selection process, right? Where we were at the first step that you have to identify the undervalued themes, ignored themes, avoid the hot themes for fresh investment. I mean, hot themes are good, right? I mean, they're in fact you make the fastest money in hot themes, right? But we basically try to prefer our investment in undervalued theme, right? And I'll talk about the journey of from undervalued to momentum to euphoria or the hot stock themes, right? Soon. Uh, then within the sector, once you have established the sectors, as a top-down approach, you identify which, I mean, what are the stocks which are, really undervalued within that sector. Because what happens is that, sometimes uh, an overall sector is not working, but within that sector, certain stocks are always working, fine. But there are overall like majority, 70, 80% stocks are still undervalued. Or sometimes the sector is not that undervalued, but still there are certain stocks which are overall pretty undervalued, right? So it's a combination of undervalued themes and undervalued stocks that we look at, right? Once the stocks are figured out, right, we try to establish a value zone, right, in which we are comfortable to basically do our investment, not at a single price, but in a range. So I'll show you a lot of charts right now, right, where you will understand what is this buying zone that we have explained in the Excel as well, right? And then we wait patiently for the buying zone. For example, if the stock is above the buying zone, then we wait. If the stock price is already within the buying zone, then you can go and start doing your investment. How you're going to investment, how much your cash you're going to deploy, we'll talk about that. And then you basically patiently, right, hold your positions in the buying zone. Now this is the most important thing, right? Because for value investing, the patience cycle can be from up to 3 months, 8 months, 12 months, and probably in worst case up to 2 years also, right? That we have seen historically, right? When the markets are brutal, the holding period can be significantly max up to 2 years as well, right? So we have to be pretty patient about. Though if you look at the data, like 60-70% of the stocks in even in the most beer, I mean the most worst beer run, they basically give you returns probably in 8 to 12 months out there, right? maybe maximum up to 15 months. But in the other 40% scenarios, I mean, they can stretch up to 2 years, right? So that is why when we give our stock recommendation, we give a minimum holding period of 3 years, right? Because 3 years is a good enough time where you can go through a bear run and then probably start seeing a bull run, rally there, right? So 3 years is a good period, but sometimes if the 3 years stretches to 4 years, so don't come after us that you said that returns have were basically going to be become or coming up in 3 years, but why it has stretched to 4 years. So it's market, anything can happen, right? If some war happens or India goes through a pretty bad phase, nothing we can do about it, right? uh, and then the last part is, when the momentum starts coming up and eventually the stock moves into the euphoria zone, that is where we have to sell and, do the profit booking. Now, this momentum to euphoria zone can last from anywhere up to 6 months to 2 years, 3 years. This is long you would ideally see a bull run to last, right? Where a maximum money will be getting made. It's not that it's not going to happen for next 5 years. It can, but the rate of rise and the rate of money that you gather in these 3 years is probably going to be slightly lesser than the subsequent years, right? We'll talk about that part as well. Any questions till this point of time from anyone before we move on? Like, so far we have covered the process, but we have a lot of things to cover. So anything very quickly. Let's not be stock specific though, right? Anything with the process. Otherwise, we are going to move to the next step. Okay. Uh, yeah, so I thought that probably it's good to start with the case studies, right? And right now the case studies are going to focus on the immediate top 25 stocks that we have released, right? So all of you would have got this report of top 25 stocks, right? In the list. So these stocks list we have prepared after carefully analyzing the Q1 stock results, stocks which are really undervalued. We have more stocks than this in our current Excel sheet, right? It does not mean by any means that those stocks are bad, right? It's just that we find these stocks to be more valuable, right? And people were really asking us that can you give us a list of 20-25 stocks only, right? That we can focus on, right? So we are going to focus on these 25 stocks in more detail, right? So before we basically talk about these stocks very quickly, I want to focus on the cash deploying strategy as well, right? Which is very important. Uh, and then we'll probably spend the later half, I think, talking about just stocks and only stocks, right, and nothing else. So cash deploying strategy means that like firstly, how big my portfolio should be, right? Let's start basically asking that question first, right? Am I comfortable with 25 stocks? Am I comfortable with 30 plus stocks? Or am I comfortable with 50 stocks or 100 stocks? What is that number? So as a data point, I want to tell you that, like we are quite data oriented. We looked into the data of, around all the stocks which gave more than 100% returns in last 1 year. In There are around 3,000 plus stocks listed on NSE and BSE, right? So around 900 stocks gave this much returns. And if you look at the data of the top holdings of different mutual funds, the overlap of stocks between those mutual funds was pretty low, which means that every mutual fund kind of had its own winners, right? So the bottom line here is that it does not matter how many stocks you have in your portfolio, as long as you have the right stocks, right, which you think that have the right fundamentals, right valuations, where they can give you 100% returns, right? That number can be 20, 50, 100, 500, 1000. Now, definitely for us, it is not possible to manage, 100 stocks, 500 stocks, because our portfolio is not that big enough, right? And we are not into a portfolio management system or a mutual fund house business where we have to manage the funds of an entire big audience, right? We are small investors and we have a reasonable portfolio. So anywhere, I think between 30 to 50 stocks portfolio per us is a decent portfolio. But if you want, to be focused on only 10 stocks, 15 stocks, that is your choice. But let's decide that number in my mind or in your mind that, what is that number that you want, that you're really comfortable with, right? For example, if the number is 25 stocks, then it means that, out of your total amount that you're going to invest, you can invest up to 4% in one stock, right? So if you have a 10 lakh portfolio, you can invest up to 25,000 in one stock, right? Excuse me. Similarly, if you have a now that's a number with the 25 stocks, right? Similarly, if you want to invest only 3%, per stock, that gives you a maximum of 33 stocks, right? So, with around, with a 10 lakh portfolio with 25 stocks, the number is 40,000, right? So it's a 40,000 that you can invest per stock. And now with 3% allocation, you can invest up to 33,000, right, in one stock, and that gives you 33 stocks. With 2% per allocation, right, per stock, you basically get around 50 stocks out there, right? So I hope this entire thing is clear, right, to you. Now, we personally, in the past have managed different portfolios. We have seen that, the 50 stock portfolio also gives you good returns. The 25 stocks portfolio also gives you good return. The more concentrated portfolio gives you quite good returns when your overall portfolio is, pretty small. But suppose that you are looking at a portfolio of around 10 CR, 50 CR, 100 CR. Say in future somewhere we we personally are aiming for 500 CR, right? In future at some point of time, we definitely want to basically be there. And in that point of time, it becomes very difficult, to operate with a concentrated portfolio, because suppose you are having a 500 CR portfolio, right? And you're just only focusing on 25 stocks, right? So that gives you around what I think 20 CR per stock, right? That you have to invest. And if you are looking at a very small market cap company, the free float or the outstanding shares are very small. So it will take you quite a long period of time, to build your positions when your portfolio becomes, pretty large. That is why, and we'll talk about that also, right? Why stocks basically stay in a buying range for a long period of time. Because the big institutions really need time to do the right accumulation, right? We think that, okay, the stock has gone up 10%, let's buy immediately, but it never happens, right? Because after the stock is immediately 10% up, what happens is that stock again corrects, again, some institution comes and buy the stock up by 5-10%, again the price goes down. So retailer in between think that, the price is not going anywhere, and I'm stuck here for a long time, right? So this is exactly what big institutions do, right? They play with your patience, and more than playing with the patience, they actually need time, right, to build those positions up, right? So it's not that they're actually trying to manipulate market; it's just that their portfolios are so huge, right? The money and the funds that they're managing, that they really need time, right, to build their positions. So we really want to basically think like big institutions, and that is where we'll be totally fine, if we are managing 100 stocks as well at some point of time. So that is why choosing this number is important. But for you guys, it is fine if you are choosing somewhere between say 25 to 40 stocks out there, right, in your portfolios. So the cash deploying strategy is very important, right? Now there are three options, right, possible here in order to deploy your cash. So number step one is clear that we have chosen how many stocks I want to, personally invest. Say that number is 25 or maybe 30 for the timing, right? So we have three possible options to deploy our cash, right? First option is lump sum investing. Second is continuous investing. Third is, the monthly SIP investing, right? So let's talk about each of these very quickly, right? So let's talk about the lump sum strategy. What lump sum strategy says that uh, I am going to not invest in the market until I see some sizable corrections, right, in the stock market, right? Now, what does that mean, right? So, if you look at the small cap index, right, the small cap index, very quickly, let me share my screen, right? So, this is a nifty small cap, right? You can see my screen. So, you can see the chart, right? Anyone can confirm because I switched the PPT to chart. Oh, let me just confirm it. Okay, yeah. So, if you look at this chart, this is on a monthly basis, right? Because that is where you can see everything in this one short space. So if you go and let me hide it, and you pick this part. So this is what a correction means, right? Say June 2014, stock market corrected here by 10-13%, right? And then Probably in May 15, the stock market corrected by 21%. Here, the stock market corrected by around 20%, right? So this is small cap index, right? I'll talk about Nifty also. And then something worst happened in 2018, right? This is the worst crash, one of the worst crashes that happened in small cap and mid cap stocks, because at this point of time, a major change was brought by SEBI, saying that earlier the fund houses were, buying both small cap stocks, mid cap stocks in a large cap portfolio as well, right? To generate more returns. They were selling the plans as if that, this is a risk free, investment because the focus is on large cap, but they silently, were buying the small cap stocks as well. So SEBI brought up with that important change that, no, you cannot do that, right? In a large cap portfolio, right, which you are claiming as a risk free option, you only have to add risk free stocks only, right? So this way, the mutual funds did a massive selling of, the small cap and mid cap stocks, and the small cap fell up to 44%. And then what happened? The COVID happened, right, in March 2020, and again market fell here. So from 2018, right, till here, the overall small cap index level fell by 60-70%, right? And when you are down something by 70%, to take the same appreciation up, you have to go up by 200%, right? Like this, right? So this is how, the rules of profit and loss works, right? If you are down by 50%, which means that you have to go up by 100%, to make up that loss. So people basically who invested in markets at this point of time, they saw good returns being made here, right? And basically what happened in 2022, the Russia Ukraine war happened, and the small cap only corrected by just 35%, right? Like this much. And this was a state of huge panic, right? Like people were constantly, worried. Like if you were connected on social media, on Twitter, on different investment forums, YouTube, people were like, when will my stock investment that I bought here will, come at break even, right? What break even means that the price at which you have bought, you are hoping the price to come at the same level, right? And once the break even would happen, and then profit booking will happen, the profit will happen, right? So they learned their lessons harder way, right? Because people who had no idea about market, who entered just because, COVID happened and there was a lot of hype around, markets are down, sell everything and invest, they, eventually learned their lesson harder way in this phase. And what happened after that? We are right now from this bottom again have seen a massive, 130% rally in the index level itself. So if you basically go it or count it from this level, right, we are around 450% up, right, which is like six times up from COVID bottom at index level. So just imagine about an individual stocks, right? You might have gained more than this, right, in some of the stocks, right? In some of the stocks, you probably still have not made more money. So that is why it's a combination. That is why the index is at 5 to 6 times level, right? So the idea that I was trying to explain is we started off from the lump sum investment mode. The lump sum investment mode says that, find out the most common corrections that happen, right? So the most common corrections probably are the smaller corrections, like here it is a 10% correction or probably 20% correction, 30% correction. But the corrections that give you the maximum returns is, kind of a 40% or 60% correction. So a person who can become very patient, right, who says that, okay, I'm going to invest in the market when the small cap index has at least fallen by 20%, or 30%, can probably end up making, more money. But for that to happen, market actually have to, keep correcting by 30%, 40% frequently enough, right? But that doesn't happen, and no one knows that, whether we will see that kind of, frequency where markets are correcting by that percentage or not. So what we thought that, if you break all these corrections into 4 or 5 categories, you say that, okay, let's take 4 examples. First category is when the small cap index is correcting by 10%. Second scenario is the small cap index is correcting by 20%. Third case is the small cap index is, correcting by 30%. And then the last is, greater than 40%. So what I'm going to do is I'm going to invest 25% of my portfolio every time there is, this much kind of crash. So first 10% you invest, if you have a 10 lakh portfolio, invest 25 lakhs. Oh, sorry, 2.5 lakhs. And then if overall correction is 20% from the top, invest another 2.5 lakhs. And then for 30%, you invest another 25 lakh or 2.5 lakhs. And then your remaining 2.5 lakh you can decide, after 40% fall. So this is how you can incrementally, add your deploy your portfolio in a lump sum manner. You can very easily say that, okay, probably I'm not going to touch market until I see a 20% correction. So probably at 20% I'm going to deploy my 50%, and then probably on another 20% I'm going to deploy another, 50% or maybe 30%. So you can develop your own rules, right? There is nothing right or wrong about it. But the idea is that, with a lump sum investment, you're not basically investing your entire money that you have, right, in one go, right? Now, that is one way basically to do the lump sum investing. What is the other way, right? The other way is that, I am not comfortable with the charts, right? Because a lot of people in this group also, right, and in general also, they're not comfortable with tracking the nifty small cap charts, right? By the way, we help you for that as well, right? We help you with that. We anyways provide you indication on the group. But sometimes people think that, no, I don't want to track the index. Is there some other better way that I can track to do the lump sum investment? So we have the concept of our Excel sheet, right? So this is the Excel sheet that all of you guys have access to, right? Let me just sort it out. Now, all of you have seen this Excel sheet, right? Right now, let me just sort it up. Right now, there are around 14 stocks which says that in the buying zone, yes, right? So what does it mean? We have for each stock defined this buying zone, like Web of Global has current price 305, it is below the buying zone. Shankara Build Corp below the buying zone, Bandhan Bank within the buying zone but on the lower side, and SIS again somewhere midway of the buying zone, right? So these 14 stocks right now are closely, they are actually within the buying zone, right? And then if you look at the next, basically, these 25 stocks or so, they are pretty close to the buying zone, but they are not exactly within the buying zone, right? So what happens when market corrects, right? Like if you look at this Excel sheet or the screenshot that we share, a month back, around 5 to 7 stocks were in buying zone. So let's talk about, the day of election. When the day of election happened, there was an extreme fear that, Modi government is not going to come. The count was around, 30 to 35 stocks that actually, were showing buying zone, yes. And then, next day it was all clear that, there was a vote of confidence, the NDA is going to form government and whatnot. Then, there was a recovery that happened in stock market, and we saw at least 20% gain in our portfolio as well, right? And that is when around 5 to 7 stocks were in the buying zone. Now, again, since last, I think 2 weeks or more, right? What has happened is the Nikkei index, right, which is Japan stock market index. I mean, that suddenly crashed, right, by a good percentage. Reason being because they were hiking the interest rate, right, and that triggered fall and correction across the entire global markets. Nasdaq started falling. Nifty also, started in the correction mode. And from that, we basically are now to 14 stocks in buying zone, right? We are still not exactly in now. We are in the 14 stock, right? So as a baseline, I know that at the day of correction, or at the day of election, around 35 stocks were there. Right now, around 14 stocks are there. In the worst case, we have seen around 50, 70 stocks coming in buying zone also, right? Which is the extreme fear mode, right? So what this buying zone is telling me that, it is actually telling me the direction of market, right? uh, if you look at Nifty, right, for example, this is small cap index, right? So from the top, it is only down by right now 4%, right? If you go and look at Nifty, right, it is only like, let me just clear the drawings. It is only down by how much? I think 2% or 3% from the top, right? That's it. So we are still not there exactly in the fear zone, right? We were there, but now we are seeing some recovery in the last, I think, 3 4 days. We are seeing some good recovery in market again, right? So I earlier told you that, you can look at the index level, like small cap index. Why we want to focus on small caps? Because around 70 to 80% of our stocks are focused on small and mid cap, right? So for us, it is important to track small cap index, right? So what we told that, probably if you look for around 20% fall, that is when, you can do a good 50% portfolio investment. So we are still not there, right? And similarly, if you look at the buying zone concept, right? we are saying that around 10 stocks, you should be around 25% allocated. With 20 stocks, you can be probably another 25%, allocation that you can do. So we are not still there, right? So both buying zone model and the small cap index tracking model are telling you that, you can somewhere in between 30 to 40% invested at this point of time. Even the small cap correction is telling you, it is only just 4% from the top, or 5%. You can even be lesser than that you are invested, right? But the buying zone model is telling you, you can invest probably more, right? Because buying zone model, is actually tracking more at individual stocks, and those stocks are not necessarily part of the small cap index. Like small cap index only has around 200 stocks, right? There are 3,000 stocks there in the market. So it does not mean that when the indexes are, just only 4 5% down, then all the entire market also, needs to be 4 5% down, or all the stocks are 4 5% down. So individual stocks can have their own, falls and highs, right? Compared to market. So I think this is the lump sum model of, deploying cash. But the idea is that, with lump sum model, whenever you think that, okay, I have to invest 25% of my portfolio, I'm going to invest equally in all the stocks in the buying zone. That is option one. Other option is that, if you are only going to pick 20 stocks, right? So identify your 20 stocks. You have this entire Excel sheet, right? For us, all the stocks are good, right? We have given you top 25 stock list as well, right? Which is here. We have given you this list. If you are comfortable with 25 stocks, identify your 25 stocks. This is this list or the list here. And then, when you have to deploy the cash, use these rules that if you have to deploy 25% cash, use your 25 stocks, right, that you have to deploy in, see which all stocks are in the buying zone, and then, invest that percentage equally in all those stocks, right? This is the lump sum model. We'll talk about the continuous model where we prefer to invest 1% at a time, right? That is the second strategy. We'll come to that, right? So what we are saying that invest equally in stocks, all the stocks in buying zone. Like for example, you go to this Excel, suppose that market is down by 10%. You say that I have to invest 2.5 lakhs. What you do is you basically choose these 14 stocks. You divide your 2.5 lakh, right? 2500 something like this, right? By this 14 stocks, which is like around 17,000 investment per stock. You go and do that investment, right? That is option one. The other option is that you have identified your own 25 stock list, and out of the 25 stock list, suppose these are the 10 stocks that you like these are the 10 stocks that you like, right? Maybe you don't like the other stocks. So what you do is that you basically see that, okay, right now market is in a good state to invest 2.5 lakh. My preferred stocks are only, these 10 stocks. So basically what you do is that, you go and basically divide equally that amount in each of these stocks, right? So divided by 10, then your investment is 25,000. Now you have to ensure that you are not breaking the percentage allocation rule, right? Like what percentage allocation rule means is, like with your 10 lakh portfolio, if you are going to invest maximum 25 lakhs, then you cannot go past 40,000 in one stock, right? So if there's certain stock like Vaibhav Global today is in buying zone, and you are very comfortable that, Vaibhav Global is now near the very low part of the buying zone, I can probably go and, invest today 50% of that allocation. Like let's invest 20,000 today. So how did you pick that? You basically found that, out of these 14 stocks, these are the 10 stocks that I like. You basically divided that 2.5 lakh divided by 10. You say that, okay, this is the 25,000 amount that I can invest today. Let's probably invest 20,000 in Vaibhav Global today, and I'll invest 20,000 later at later point of time, right? So these are the ways that you can find out or figure out, to invest your investment in different phases, right? When are you going to invest next in Vaibhav Global? Now there are basically ways for that. Again, wait for another, market correction, like another 10% correction in market, or you can have individual stock, you know, uh, uh, fall also, that can tell you that. Say, suppose you picked Vaibhav Global at 305, and again after this purchase, the stock falls by 5 10%. So you basically do your another investment, right? Now let's talk about the worst question, right? Worst question is that probably you invested Vaibhav Global somewhere around 370, right? At this point of time, it was in buying zone and you invested it, and then you said that, okay, I am going to wait for another 10% fall in this, right? So suppose that the 10% fall takes this to 333. So you said that, okay, I invested my another 20,000 at this point of time, but now the stock price is again 300, right? What should I do? So there is a range that we defined, right? And it is totally fine that sometimes the stocks go below that buying zone, right, or buying range. We don't in this scenario never fight against a particular stock, right? Don't try to keep on investing again and again in a stock just to do the averaging out there. I tell you why. Because if you go to the bottom of the sheet, right, you look at NBCC. NBCC current price is 180, right? We suggested the stock price at around range between 30 to 40, right? On which date? 1st August 2022, right? And if you go to NBCC, right, this is NBCC chart. Let me just remove the drawings. Let's figure out when was that date, right? 1st August uh, 22, somewhere here, right? So this was the range that we identified, and the range was 30 to 40, right? Let me draw that range for you, somewhere like this, right? So what happened was, even in NBCC, the stock price broke the range here, right? And it went lower up to 26 rupees, right? So just think the same thing, right? Like Web of Global price we suggested was 330, and the stock price has gone to 300, right? So if you think it or compare it to NBCC, it's again a similar kind of model, right? That it broke your lower range, and again right now at around 300 price, right? Uh, Let me just go to Web of Global. Now, if you go and look at the Excel sheet, the stock price is 180. Do you really, I mean, does it really matter? You bought at 30, 35, 40, or 25. Like best case, you bought at 26, right? You picked the bottom. The worst case is that you invested all your money at 40. So our model anyways will not let you invest your amount at 40, right? Like best case, we tell that somewhere around 35 to 38, in between that you'll be doing the averaging. So it is totally fine, right? And that is why we basically want to diversify our portfolio a bit, so that even if some stocks go below the buying range, your portfolio doesn't hurt you much, right? And then that is where you should not be investing all your amount in just one stock, right? Even if the CEO comes and say that the stock is going to be 5x, 6x, don't break the rules, right? These roles we have established after a lot of experience, right? So this is very important. I mean, more important than stocks, right? That you need to buy. These rules are very important. So this is the lump sum strategy. Then the second strategy is the continuous portfolio investment strategy, right? This is the second strategy. Now, what does this strategy means? This strategy means that, suppose that you take an example of stock like Barbecue Nation. Barbecue Nation, in the Excel sheet, right? If you go and see the Excel sheet, let me search Barbecue Nation. Here, the buying zone is around 500 to 600, right? The stock was suggested on 26 February 2024. So what we tell that, rather than investing all your stock, I mean, rather than, so it's different than the lump sum strategy, right? Rather than investing your 2.5 lakh in one shot, you figure out, firstly, you figure out the number of stocks that you have to buy, right? Suppose that number is again 25 stocks. Your 10 lakh portfolio means that you can invest maximum of 40,000 in one stock. So what you will do in Barbecue Nation is you will divide that 40 stocks in at least 2 to 3 parts, right? So when you divide that 2 to 3%, that gives you around 1 to 1.5% at one point of time. So 1% or 1.5% of 40,000 is somewhere around 10, 15,000, right? So what I'm going to do is I'm going to invest 10 to 15,000 when Barbecue Nation is somewhere within the buying zone, like 580, 590, something like that. You go and invest your 10, 15,000. Then you again wait for some time. If the stock price again corrects by 5, 10%, you again basically invest another part of your overall 40,000, which is another 15,000 or so. So you invest that. And if you again see the price correcting a bit further or going down the buying zone, right, you invest your third part. So overall your 40,000 you've broken into 2, 3 parts and invested in a very wise manner, right? So in this scenario, you are actually not looking at what is small cap index doing, what is market doing. You're just looking at an individual stock, right? That is what your focus is. Because each and every stock will spend some good enough time in this buying zone during consolidation phase, right? And if market also corrects severely, the price even goes below the buying zone also, right? So what will happen overall in the portfolios, right? Suppose that right now there are 14 stocks in the buying zone, right? So if you are investing somewhere around 1.5% or so, right, in 10 stocks or 15 stocks, it may force you to invest up to 30% of your portfolio, right? Because like 15 into 1.5 is 22%. You will ask that, why this number is 30% and not 22%, right? Because some stocks, might be already, well below your buying zone. For example, Weber Global would have been there earlier when there were five stocks in the zone. It is even now there when there are 15 stocks in the zone, right? So maybe you already have some investment done earlier and then you are doing more investment here, right? So when the number changes from 5 to 15, what happens is that there could be 10 new stocks coming in buying zone, or maybe 12 new stocks coming in buying zone, some stocks moving out of buying zone, and some stocks probably even going further below, after you bought it, right? So overall it can be somewhere 25 to 30% portfolio allocation with the buying range kind of model, right? Where you do the incremental 1%, 1.5% investment at a time. So this is what you see in the messages every day when we say that, okay, this stock probably is in the buying zone. If you have not invested anything, you can at least invest 1.5% or 1 or 1.5%, right, at a time. You're not looking at market correction or volatility at example. Now, what experienced people do, right? In fact, let me cover the third option and then I'll talk about what experienced people do. The third option is a monthly SIP, right? It is no brainer. Like you say that, okay, I am a very peaceful kind of investor, right? I don't have time to track index. I don't have, time to track this Excel sheet on a daily basis, right? And all, I also don't have this 10 lakh portfolio in one shot to invest, right? I just have started my investing journey, right? I only have around like 10, 20,000, 50,000 maximum, a month that I can probably invest. So what can I do, right? So you can do monthly SIP, like you do SIPs in mutual fund. You pick your 50,000, suppose you have to invest 50,000 per month. You basically go and identify the stocks which are in buying zone, right? Suppose there are 10 stocks in buying zone. So you go and invest 5,000 equally, right, in all those stocks. Again, have that number in mind, that which is the number of stocks that you want to invest. Is it just only 20, 25 stocks, or you are fine all the stocks in the Excel sheet? I mean, I am totally fine that, even if I'm invested in all the stocks which are in the buying zone right now, right? But if you think that I only want to have 20 stocks in my portfolio, again, the same rules apply even in the monthly SIP option. If that number is 25 in your head, right, you go on a monthly basis, just that you are doing this activity on a monthly basis, right? Uh, you are going and checking that, okay, I have this 50,000, I've got this money. Let's identify it out of my 25 stocks, which stocks are in buying zone. And then you invest equally in that. Again, ensuring that you don't break the 4% rule, right, in one stock. It is very important. Then another option is that, rather than doing monthly SIP, you can say that, okay, I'm parking my money and I'm waiting, to invest at the right time. So when you decide that, I don't have to do a monthly SIP and I have to invest at the right time, that is when you move into into a lump sum kind of model, right? Which is or option one. So overall, there are only just three options, like, doing a lump sum investment, or doing a continuous, 1% investment, or a monthly SIP. And if you say that, okay, market is falling and I want to wait for some point of time, then the monthly SIP, it turns into the lump sum investment, where you're reserving your money or parking your money with you and then deploying it slowly as per the market direction, right? I hope this point is exactly clear to all of you. I would hold on here for any questions on the cash deploying strategy before moving on to profit booking strategy. And then we need to cover our stocks as well, right? So we are a bit short of time, but if anyone has any quick questions, just let me know, right? Okay, if we are good, probably let's hold on for questions at the end then. Let's cover more ground, right? Hope you guys are following content till this point of time, right? What we are basically trying to suggest. Anyways, now we have basically, using the cash deploying strategy, we have basically now peacefully done our investment. And usually what happens is that, there is a period of 6 months, 12 months, in which, I mean, when you have seen a good bull run, right, and the market goes through correction, it can be a period of 6 months up to 1 year when market probably goes into a sideway, into a downtrend, and then, sideway consolidation. And that is where, the new investors or the existing investors who did some profit booking previously, they try to, do their investment incrementally, right? And this can take time. After, say, a period of 1 year, 2 year, there will come a time, right? Even probably within 1 year also, you can see that time when you need to basically, you see your stocks rising probably, and they will start showing you up to 30%, 50% returns, 80% returns, right? Let me give you an example here, right? So Rosari Biotech, right, is a good example. Like we suggested the stock on 2nd April, right, in the range 650 to 730, right? And the price is right now around 914, right? So within a period of around 3 months, 4 months, right? Because chemical stocks were down for around 2 years. So now it is showing me around 30% returns, right? If considering the average pricing, average buying price was around 710, right? So again, my sell target is somewhere around 2400, but that does not mean that I need to wait until 2400, right, to basically eventually book my profit, because I don't know, right, what can happen within the next 3 years. But there are certain people, right, who thinks that no, I'm totally fine, right? I don't care. I know that whatever happens in market, the fundamentals of Rosary Biotech are so good that within 3 years, I know that it will get my money three times, right? So there are two different thought processes here, right? And then if you look at a stock like probably say Symphony, right? Let's show Symphony. So Symphony again suggested on 6 November 2023. I clearly remember that in the month of May also the price was around 950 or so. And within 2 months, the stock has given around 70-80% returns, right? And the current price is around 1686. This stock has even given no returns in the last 3 years, right? And we personally wait for some stocks in consolidation and then we suggest it. Even after suggesting, it took around 7 months, to give any returns. You take example of Lux Industries, right? So Lux Industries we talked in a previous session. Like this stock we suggested on 28th March 2023. The stock gives zero returns until May 2024, right? Like more than 1 year. And then probably in just 2 months, it has given over 80% returns, right? Now the target is around 4,000. The current price is only 2,200, right? The future target that we think is, probably is 220% return. So should we basically book some profit here, or what should we do, right? What if market falls here? Can this 80% profit remain only 50%, right? So all these questions eventually come and haunt you when the market corrects, right? So when our markets are going up, you will never, you'll always regret that, okay, why I sold this profit. Oh, the stock is going up, right? But only in the hindsight come and revisit this when the market starts falling here, right? And this 80% profit say falls to 40% profit or 50% profit, right? Then you'll think that, oh, I could have booked some profit at least. So this is a natural psychology, and there is no one right or wrong about this, right? Uh, but we basically thought that eventually you have to control your greed and figure out some way where you can do some partial profit booking, and we have tried to demonstrate some data here. Like there are overall three options. One is that you can. So my target is that, like, take an example of Rosary Biotech. Rosary Biotech had to go from 700 to 2,500. That is what we see probably in 2-3 years, right? So what can I do? Can I do some partial profit booking in between somewhere around 25% at regular intervals? Can I do a partial profit booking of say 50% at regular intervals? Or can I do a full profit booking of 100% at the 2,500 target, right? So these are the three options that you want to go with. And you can go with your numbers also, right? If you want 30%, 70%, whatever that number you want to decide, it is up to your choice, right? But for convenience, I've picked three examples here. So let us take this particular example, right? Uh, which is the option one. What option one means that I'm going to book 25% profits at regular intervals. Now, what are those intervals? First interval is that when the stock eventually gives me 50% returns, like Lux Industries gave you 50% returns, I think probably few weeks back, right? At that point of time, I'm going to go and book 25% of my profits. I mean, no question asked whether the stock goes up after that. I'm not going to, regret any decision. I'm going to book 25% profit on 50% gain. This is from the original buying price, right? I'm going to book another 25% if I get 100% gains from the original buying price, right? Now, suppose the original buying price was 1100, right? Uh, as an example, assume that the original buying price was around 100, right? So when the price become 100 to 150, right? 100 to 150. Let's look at this table, right? For better understanding. So the first column is start amount. Suppose you start with amount 100, right? Suppose your 100 amount is invested in one stock, and that stock gives you around 50% gain, right? What I'm going to do is, so my current value is 150. I'm going to book 25% profit here. So what is the profit that you booked? 25% of 150 is 38 rupees, right? Now the remaining amount is 113. Now you're going to keep your 113 amount invested, and then you're going to wait for another for 100% gain. Now this 100% gain, not from this 113 level, from your original buying level, right? So original buying amount was 100, right? Which means that somewhere when the stock price would become what, somewhere around 200, right? That is when ideally you would have, you would basically do your next sell off. Now you had around 113, right? Rupees at this point of time. So this another 100 to 200 will make your 113 to 150 again, right? So this is a mathematical computation that you'll have to do. Let's not think that, why this 113 is not 226, because that is what it will not, because you're already at 50% gain, and the journey is from that 50 to another more 50%, right? So if you will basically do that thing mathematically, you will find that the number is 150. So again, 25% of this, you are booking 38 rupees profit. Again, the amount remaining is around 113, right? Now, this time, when you go into the third phase, right? So you say that, okay, I wait for another, 50% jump, or 25, this another, uh, so you'll wait for 150%, rise from the buying price, which means that ideally, if you had not sold anything, that 100 rupees would have become 250, right? So this is the level at which you are going to take another 25% profit off, right? And this profit now becomes 35, right? And then you do that for another 25, another, uh, basically another gain up to 200%, then your profit booking is around 32 rupees, right? So if you do the overall computation, I mean, let's not worry about maths. You can, compare it on Excel as well and validate it. Your original 100 rupees, right? If you sum up the profit that you booked and the final amount that is remaining is 95, this amount comes up to be 237, right? The overall idea in my mind is that I'm booking 25% profits at every 50% jump, somewhere in the price, right, after my gain. Usually when we suggest any stock, we try to go for 200 gains at least in 3 or 4 years, right? So 200% gains is the ideal one shot clean shot approach, but we are not waiting for that clean shot approach. We are booking profits incrementally in four parts. We have broken that down into four phases: 50, 50, 50, 50, and at each rise I'm going to book some 25% profit. So my overall amount final value after, after these gains become 237. Now, suppose that you were able to achieve this 237 value with 25% profit booking in 2 years, your CAGR comes around 53%. If it took around 3 years, right, for you, for example, Lux Industries take around 3 years, right, from 1100 to 4000. Like it has given you very quickly 80% now. It did not give you any return in last 1 year, right? And then probably again it can happen that for 3 months it do nothing, and probably another 6 months, it gives you more returns. But my rules are clear, right? Every time I see those percentages getting hit, I'm going to, trigger 25% sell off. So you'll end up getting around 30% CAGR if this thing happens in 3 years. And suppose that, the market goes into correction, right, for 4 years, you end up getting 25% CAGR in the worst case, right here. Now, the option two here is that, right, which is do the 50% blocking, 50% profit booking on at least 100% gains, right? So now we are not booking profits on 50%, but we have done two changes here. Firstly, we are booking 50% profits here, right? And we are booking 50% profits on at least 100% gains, right? So which means that until Lux Industries become 1100 to 2200, I'm not going to book any profits. But when it becomes 2200, I'm going to book at least 50% profits, right? So again, you start with 100 rupees amount. When you receive 100% gains, the current value becomes 200. You book 50% profits. So 100 rupees is your profit, and 100 is the amount which is left. You again invest that 100 rupees profit, right? And when the stock price, say Lux Industries become from say 2200 to 3300, right? So which is like 200% gain, right, from the initial 100 amount. You again basically book 50% profit, and this time your profit book is 75 rupees, and 75 is still remaining, right? So if you add up the 75 remaining value and the profit book, which is 175, this amount comes to be 250. So in the previous option one, the amount was 237, right? Sorry, I did not computed the 2 year CAGR in this one, but the 2 year CAGR in this option will come somewhere around 58 to 60%, right? But if the same thing happens in 3 years, you get a 33% CAGR, right? Compared to the previous option, I think there is some correction that I had to do. This was not 33%. Uh, I think there is some correction that I needed to do. Like in one option, it was definitely 37 or 38%. Probably in the previous one, it was 33%. Maybe there is a correction that I needed to do. But in the 4 years, there is not much, significant improvement here, right? It is like 26% CAGR. Previous one, it was only 24% CAGR. Now, third option is that you actually say that okay, I have done my investment peacefully. I don't want to do all this shit rat. I don't want to wait for different phases and book continuous profits. I know that I'm experienced person. No matter market goes down, goes up, eventually my 3x profit will come. Doesn't matter it comes in 3 years or 4 years, but it will come. So if you sit idle and you wait for your investment to become 3x, within 3 years, your CAGR will be 44%, and with 4 year time frame, it will be 30%. So you see that eventually people who have patience to wait for long enough, they're going to get good CAGR. Now, what happens after 3 years, right? So sometimes it is very difficult, to reason about the state after 3 years. Like Lux Industries, when it becomes say 4,000 in 2 3 years, after that 2 3 things happen, right? You think that Lux is still pretty undervalued. It is only 8 10,000 market crore cap. Page Industries, which is the leader, is at around 50,000 market cap. So Lux can still like go probably 4x 5x from here. But I'm not sure about it, right? So in that scenario, it probably makes sense that at 200% gains, you book at least 50% profit and leave the other part invested forever, right? In case that it can become a multi-bagger opportunity. Like what is a multi-bagger, right? Right now, what we are doing we are focusing on stocks to become 3x, right? Why we say a 3x opportunity as a multi-bagger, because if you are able to achieve this thing in two times, right? Like 3x multiply by 3x, it is 9x, right? So you might think that okay, 3x return is probably not as good as a 10x return, but if you can achieve that thing two times, right? So that eventually becomes 9x, right? Which is 10x, right? So that is why a 3x return is very lucrative and reasonable, because it gives I have more clarity about a company in the next 3 years for sure. Definitely in the next 10 years also the company can do even more better, right? And what we have seen historically is that companies which are multi-bagger, they actually end up giving you around 20x, 50x returns in 7 to 10 years, right? That happens. But we have also seen that if the sector is cyclical and the stock is cyclical, right? What happens is that after 200% gains, the stock again corrects by around 50%, and you wonder that my profit is now down from 200% to only 100%, right? I wish I would have booked some profit, right? So to avoid that kind of regret and to keep your overall greed in check, it is wise to do some sort of consistent profit booking, right? And in market there are so many opportunities, right? That sometimes you all think that I'm fully invested or I don't have cash, what should I do, right? So you would have seen that recently we gave around 20% 30% profit booking recommendation on Lux Industries on Symphony. Now we know that, we personally know that the stock will go, even beyond that. But it is a discipline that forces us, to book some profits, because markets are pretty unpredictable also, right, at times. And sometimes even the 20 30% profit that you booked, right, and a certain stock like Vaibhav Global, right, say corrects by another 10 20% from there on. So effectively you are able to, get a value of 40% or so, right, out of that 20 30% profit you booked, right? So the profit that you're booking, and you're trying to add that profit on a stock that another falls by 10% is pretty pleasing, right? So I hope you're getting my point here. So profit booking is very important overall. So I think we have talked about cash deploying strategies, we have talked about profit booking, and now it's time. I think you are all eagerly waiting to move over to stocks, right? Because stock is what gives you most conviction. Here we're going to get our next 5x, 10x kind of return. Before we go there, just think that always believe in making or generating wealth slowly, right? Don't think about like someone was asking me, you're not investing in the hot stocks like renewable energy, the power stock, Suzlon, right, has become 40x, 50x. What are we going to do about it, right? And then I asked that person one question that, suppose you had a 50 crore portfolio, right, with you, and suppose Suzlon was selling at around 1 or 2 rupees, right? It fell from 100 rupees. Would you really have that courage, right, to go and invest 10 crores out of that 50 crores, right, in Suzlon, right? Because that 10 crores would have become today 500 CR, right, with 50 times from what Suzlon has done. So it is very difficult. But yes, what I could have done is that probably in my 50 crore portfolio, I know that 40 crore portfolio is, is placed in well-defined value invested stocks. If the 10 crore portfolio is something that you are willing to lose, right? So I'm going to go and invest probably in 10 penny stocks out there, which probably, are looking good turnaround candidates. And even if, you lose the 10 crore, you're not going to have any regrets. But even if one stock out of the 10 crore, right, works, which means that 1 crore works, so that 1 crore has potential to generate probably to go 20 times, 30 times, 50 times, which is like, another 20 CR, 50 CR, right? So these are the things that probably you can do about, right? But it is still not wise to go and invest all your money in a particular hot stock, right? That is not how it should be. And believe me that if you really want to get a pretty peaceful way of investing, a regular way of generating profits, I think try to pick companies which are fundamentally good, and where the chances of losing money is pretty low. It is a hard-earned money, respect that. Don't think of generating or becoming the next Ambani's, right, or the next Rakesh Jhunjhunwala's, right, immediately, right. Eventually things will fall in place, right, if you do things right, slowly, steadily. Don't think of like if I talk about my personal ambition, I'm not thinking about 50 CR, 100 CR, right? I personally think of dreaming about probably 1,000 CR from market, 5,000 CR from market, and I'm totally fine that I'm not able to do it on my own, but my children are able to live my dream there, right? And they are able to carry on the processes that I'm developed, right? Because in 30, 40 years, I'm sure that number will be there, right? It's fine that if I'm not able to get that number in 20 CR, in 20 years, right? You should definitely think of becoming financially free, but let's not think about generating so much money, so much wealth, quickly. You have a good if you are working in a job, just be loyal to that, because the money that you get from your job eventually always helps you out, especially when market goes through a bad phase, right, bad correction period. So always until you are like 45, 50, don't think of leaving your job, because that is also another kind of investment that you are doing, right? The more years you are investing into market or into companies, they are also rewarding you, right, in the longer run. So yes, let's with that note, let's come back to stocks. But before we talk about stocks, anyone has any questions at this point of time, right? If you want to ask, uh, Gaurav, I think I see your hands up. Sorry. Yeah, right. So let's do one thing. I think since we are short on time, so in the chat pod, let's please paste specific stocks that you guys feel worried about or not comfortable about, and then we can talk about it, right? Let's start probably from Barbecue Nation, and then we can talk about other stocks as well, right? Uh, let's probably start with Barbecue Nation, and then I'll come back to the chat pod again, right? Meanwhile, feel free to add, right? So let's talk about Barbecue Nation, right? Uh, remove the drawings. So let's go to Screener, right? It's a good tool, right, to explore different stocks. If you guys are not used to, just think about it. And let's go to peers. So firstly, Barbecue Nation belongs to a quick service restaurant category, which is the restaurant sector, and the industry is hotels here, right? Within that, only seven stocks are there: Jubilant Food, Devyani, Westlife Food, Sapphire Foods, Restaurant Brand Asia, Barbecue Nation, and Coffee Day, right? Now, if you go and look at these stocks, right, let's probably choose another stock, which is say Restaurant Brand Asia, right? You see that there is a certain trend that you find with each of these stocks, right? Let me write RBA, right? So this stock also is pretty much down from the all-time high price, which is this around 50% down. And then probably let's go to Jubilant Food, right, out there. So there is a certain trend that you will find, with each of the QSR stocks. And that is where I say that, identifying the undervalued theme. That if some problem is happening, with the entire sector or theme, then what is that, right? Like Jubilant Foodworks, again, was around 55% down somewhere in March 2023. And it was almost similar down in March 2024 as well, right? No return almost in 3 years. Like the top was in 2021. Now, if you go and look at these stocks again, right? So why these stocks are down? Like let's figure out the reason. When this entire online delivery kind of system came up, the margins, the revenue of these companies started getting affected, right? There was a bit drop in sales, and then all discussions were happening that people will stop going to fine dining or to go to these cafes and restaurants, and that is where the drop in revenue started occurring. But eventually, these restaurants at the time, what did was, they basically transitioned slightly into the delivery based model as well. And then they started eventually getting, revenues from that as well. And then fine dining also, got bit affected, due to the high inflation period. People were, really trying to save, on things which are, kind of discretionary, right? Like you can avoid, right? Like you cannot avoid, food at home, right? You really need food, but you can avoid, fine dining. Probably, rather than going every month, you say that okay, it's fine to go every 2 months, right? That kind of thing happens during high inflation periods, right? So that was another reason, right, that probably affected the overall sales of these companies, right? And similarly, the margins, right? Margins is the profits that you get after the expenses. So during inflation periods, the raw material prices and everything shoots up, right? So what happens with textile stocks or the food delivery stocks or the consumer durables, right? Consumer stocks, the overall expenses increases and that affects the net profit, right? So the net profit takes suffering for two reasons. Like one, the sales going down, and then the other is the overall expenses slightly going up. Now, if you look at Barbecue Nation, right? Let's go back here. Let's look at the fundamentals, right? Eventually, what was reflected in the fundamentals. So above is the total revenue figure, right? Since around 2021, right? You can see this. So this is revenue. This is EPS, which is earning per share. This is the price chart, right? And this is the PE ratio, and this is the price to book ratio. So if you see when the IPO came right here for Barbecue Nation, the stock price basically went up from 500 to around 2000, right? That was the top that it made. The top could not be sustained even for more than 1 month, right? And the price dropped and somewhere settled around 1500, right? So what happened right at that point of time? What was the price to book ratio? The price to book ratio was somewhere around 15, right? Now that is huge. I mean, ideally for foods, the restaurant stocks, the price to book ratio should not be more than 3, 4, 5. I mean, maximum. I mean, that is an ideal one, right? Maybe 6, right? That is what you can imagine. But 15 price to book, is too high, right? I mean, what are you basically banking on that particular high, price to book value? You look at the PE, right? The PE was like at this point of time, you will say negative, right? Now we'll talk about why the PE ratio is negative for price to for restaurant stock, right? But we'll come back to the PE in a moment, right? What happened after that? It moved into an entire downtrend here, right? Somewhere here, and then the downtrend started slowing down a bit, right? This was this steep here, but then the downtrend started becoming lesser steep probably here, and then now we are somewhere in a base formation, right? So the technicals are telling me that somewhere the price is now settling down, right? So that is the technical part, and then we'll talk about the business part as well. Now what is happening at the business level, right? The business level company sales were around 200 crores, right? Something like that a quarter. The sales are always rising right here at this point of time. There was a minor dip in this particular level, but even if you draw a horizontal line right here, comparing to last 12 quarters, you are still well above that line, right? You can see this, right? This zone. Now, I was willing to basically pay 500 to 2000 for this stock, with this kind of sales structure. But after 12 quarters, when the sales are, increasing steadily, and I'm still not basically willing to pay, the same pricing here. Like what was that, I wanted to pay so high valuations at this point of time, right? So, which means that somewhere the fundamentals are becoming, more value attractive, right? But the price, is going against that direction. But now the price is also, trying to settle down, right? So that is one divergence that we look into. Now let's look into the profit side of things, right? For restaurant stocks, ideally when they are growing stocks, right? What growing stock means is that when the market cap is very small, like Barbie Nation is only 2,000 crore market cap right now, right? If you go and look at the operating profits, right? This is the operating profit. So there is a difference between operating profit and the net profit. Uh, the operating profits in 2021 for 220 crore sales were around 41 crores, right? Then it went up to 65 crores. It went into 70 crores here. And then somewhere there was a drop started coming in operating profit, right? Which is fine because somewhere the expenses started to increase a bit. But now we can see that the operating profits again are slightly coming back, right? From 39, 40, they are again coming back to 66, 54, 50. And it's a quarter on quarter thing because like in winters you like going more to barbecue nation kind of restaurants. In summer you go less, right? So that is why it is a seasonal stock. So you have to look into quarter on quarter comparison rather than doing a previous quarter comparison here, right? So things are actually improving here. Now, why is the net profit negative here? Net profit is negative because of because of two reasons. One is they are paying interest, which means that they have taken some debt, but the debt has not been changed for around 3 years, right? It was 17 crores and now almost around 18 crores interest that they're paying. So that is not a big worrying for factor for me, but there is a huge depreciation entry that they have shown in the balance sheet. Now depreciation entry is only a entry in the books of record. What this means is that when you are setting up a restaurant like Barbecue Nation, there is a lot of inventory that you have to buy initially, and that inventory is an asset that eventually will become or will depreciate over a period of life. Like there is a chair, right, that you buy. You say that okay, this chair is going to probably last till 5 years. So if I bought this chair for 100 rupees, this 100 is eventually going to become zero over 5 years. So what you do is that you divide that 100 over 60 months, you come up with certain amount and you show that as a depreciating expense in this particular entry. But it is not that the cash flows are affected, right? Which means that the cash is coming. Whatever operating cash minus this interest that you are paying is the net cash, right? And you have to go and check the cash flow statement in this scenario. That is the cash coming really, right? So the cash is actually coming. You see that they have 214 crores cash which is coming in, and what they're actually doing is it's a net cash, right? They're actually doing 121 crores in financing activity and they're spending 106 crores in the investing activity. So where are they investing? They are actually doing the capex, right? They are buying the fixed assets, somewhere they are probably doing they are renting out things, or somewhere they are buying those restaurant spaces out there. So it's growing, right? And you go and check the balance sheet out there, you can see here also, right? Let's look at the assets. The assets have increased from 165 crore in 2016 to somewhere around 1000 crore, right? And in which the building cost is around 1200 crore, right? Now think about Barbecue Nation, right? If it invested in buying some buildings, right, or spaces of its own, if it's not a rented property, do you think that if it brought some property at 200 crores, the price of that property is still 200 crores? No. But in books of record, it is still mentioned 200 crores, right? The overall market cap is only 2000 crore, right? Out of which 1200 crores are like fixed assets, right? And those fixed assets again are not valued correctly to the current state, right? Because like certain property that you buy, right, 1 crore flat you buy, if that becomes 10 crores, it's not that the company is going to update its value at 10 crore, right? But if you have to, if I ask you, can you do a similar Barbecue Nation setup across 200 cities, right? Barbecue Nation is spread across 222 cities. I give you only 2000 crore investment. Can you do that setup? You may be, or you may be able to not, right, set up that thing. So overall Barbecue Nation is highly undervalued, right? And then you look at other fundamentals, right? You look at the ROC, it is good, reasonable, 5%, 6%, right? Because the margins are not that huge, right, on the initial capital. With restaurant stocks, it's always like this, right? You go and look at the operating, I think, the OPM, right? Operating profit margins. This is highest in the restaurant stock, right? 18%. If you want to compare this, let me just show you OPM, right? And you see Jubilant Food has around 20%, then Sapphire Foods has around 17%, but the market cap of Sapphire Foods is how much? It's 10,000 crore. Now Barbecue Nation only 2,000 crore market cap and has OPM of around 17.5%, right? It is like what, top three, right, in that figure. So there is a huge potential for the restaurant stocks, right, to basically perform from there, right? And a similar reasoning go for restaurant brand Asia also. Now, what happens basically technically in restaurant brand in barbecue nation, right? The stock actually, when we came up with the buying zone, right? How do we identify the buying zone? And then you can probably do the same thing for other stocks as well, right? We look at the stocks which basically have risen a bit in the past, right? Shown some kind of performance, and then due to some bad reasons, they are down, right? So we try to identify the support zone, right, where the stock is basically falling and has previously also consolidated. So we think that okay, let's probably draw here this range, but the stock is still in the downtrend, right? We want to wait for some consolidation period, right? So you draw these lines somewhere and then see, where do you find the most consolidation happening here, right? So we gave the recommendation somewhere of our barbecue nation in this amount of this period of time, right? April 24 or so, somewhere I think after this, right? So the stock somewhere was around 606 at that point of time. So we thought that worst case the stock falls, it falls probably up to this last level, the IPO price which was there. So we gave the range of around 500 to 600. Now what happened on election day, the stock fell up to 470 or 460 also at this point of time, but more or less the stock has been consolidating for around 6 months in this range. Now, if you would have watched the stock very closely during the last 4 or 5 days when the market was falling, right? You go and check on the daily charts or maybe minute charts. The stock, someone was buying it every day, right? You see these big spikes happening there, and that is where the stock even got 10% up. I think yesterday at the last closing day, right? Now, what should we do, right? The stock price is now in a matter of only one day jumped from 570 to 630 or so, right? So this is what I was telling earlier, right? Like some operator, some big player, actually has found value in barbecue nation, but it will take them some time, right, to accumulate their position. So it can happen that let me just go back to the monthly chart again and do the reset of chart view. It can again happen that the stock probably corrects somewhere here, right? Let me just use the other freehand tool. The stock corrects somewhere here, consolidates more here, then comes here, then it comes here. But overall, in a period of 3 years or more, we know that it is definitely going to hit its all-time high, right? So this is the thing that we are fully sure about that like if company sales are growing, net profits are going, eventually things are improving, it is in the capex phase, right? That is why there is a lot of depreciation entries recorded there. So we are sure for the 200%, right? For absolutely sure, right? Now after 3x gain, the market cap will still be like from 2000 crore to 6000 crore. Now if you look at the parent, the big player, which is Jubilant Food, right? It is at 42,100 market crore, right? And look at who has invested in barbecue nation, right? You asked for what gave us confidence. You look into the investors, you go into the public investment holding. Jubilant Foodworks has invested around 10%, right, stakes in barbecue nation. Now why would, and it has not changed its stake for the last 3 years or so, right? So Jubilant Foodworks market cap itself is 4200 crore, 42,000 crore. Now what is Jubilant Foodworks? The company that makes Domino's Pizza, right? So Domino's Pizza, everyone know about it. Maybe some of you don't know about Jubilant Foodworks, right? But that company, now look at the history of Jubilant Foodworks, how this company has performed in the past, right? Does Barbecue Nation show a similar kind of structure to me? So let's open Jubilant Foodworks, right, and go back in the past. Let me reset the chart view, right? So Jubilant Foodworks started its journey somewhere here, right? After the 2008 crash was settling down. So Jubilant Foodworks was showing me pretty good returns, I think, in the initial 10 years, right? So it was good. But then this correction happened, right? Which took the stock price down by a significant amount, right? Which was around how much? 50-60% fall. So Barbecue Nation also, is suffering from the same problem. And then this consolidation, once it got over, right? So again, from low of 85, the stock price shot up to 900, right? Again, a 10x gain. Again, there was a 55-60% correction. What will happen again? Again, the consolidation can happen. Now, when the company start becoming big, right? In the Smile Chocolate, we also suggested Jubilant Foodwork here. I don't know how much of you guys were able to catch it because the range was 400 to 450 and it came around 440 or so and then got it back retrace from here, right? So in this stock, we know that 100% for sure returns will be there, right? It's a large cap. Don't expect 3x, 4x returns here, but you never know, right? That sometimes what these stocks do is that there is a technical cup and handle pattern coming in here, and then the stock probably reaches here also. So from the bottom, you will end up getting again like a 200% returns, even in a large company like Jubilant Food. So overall, you have to play according to a theme, right? So QSR theme is something where in Jubilant Food, in Restaurant Brand Asia, which is Burger King and Barbecue Nation, you can invest as a theme and then look for somewhere around 200% returns in next 3 years, maybe maximum 4 years. That is what the overall philosophy was to pick this stock. So hope Gaurav, I mean that is answered. SBI cards and Yes Bank from Hitesh. Okay, let's talk about that. But I basically wanted to cover about one stock which right now are a bit down from top, which is a Vaibhav Global, right? I know some of you might have invested and a bit worried about the stock. So firstly, tell me about why we picked Vaibhav Global, right, and how we picked its range. Vaibhav Global is a leading player in the online jewelry segment, right? And it's most of its clients are primarily in USA, UK, Germany, and few other global countries as well. So and its market cap is only 5,000 crore right now, right? Any company which has such good global presence, has a lot of credibility, right? If it's doing things right. So if you look at the journey of Vaibhav Global, right, somewhere here, right, uh, the stock price started, I think, in 2013. It listed here very quickly from 22 rupees. It caught up to 155 rupees. It was 7x returns. And then the stock from 2014 to 2016 went into a limbo, right? Was around 75% down. Then, again, like we could have basically, if we were investing in 2016, we could have picked stock here if the fundamentals were good, right? So, were the fundamentals good here? Like, has it shown a similar trend in the history, right? Also, how can I validate that part, right? It's very easy. Basically, what was the market cap, right? What is the market cap right now? Let's go and check Vaibhav Global, right? Here, Vaibhav Global. So Vaibhav Global market cap is 5,000 crore. What is the stock price? The stock price is 300 rupees. So what would have been the market cap when the stock price was say 50 rupees somewhere in 2016, right? So what should I do? I divide 5,000 crore divided by current price, which is 300, and I multiply that by 50, right? So I get around 800 crore market cap somewhere in 2016 phase, right? Let me highlight it specifically. So the stock price was selling somewhere between 40 to 60 rupees during this time. Understood? Now let us see what was the sales margins, right? Profits of Weber Global during 2016 period. So you go to screener again, you go and check at the 2016 data. You see that okay, in 2013 the company's sales were 800, 900 crores. By 2016 the sales were around 1200 crore, right? Amazing. Like a company with only 800 market crore cap has 1200 crores of sales, right? The net profit of this company was around 100 crores in 2015. It dropped to 40 crores, right? So you see there is a drop in this net profit, and that is where the stock price got fell by around 70%, right? And then the profit started improving here, 65 crores. It went to highest ever here, I think 112 crore probably. No, highest level is 154 crore in 2019, right? So you can see there is a consistent rise in net profits after that, after this drop of 2016. But what was the P, the price to earning ratio in 2015 and 2016, right? So let's go and check the price to earning ratio here, right? So price to earning ratio in 2016 was still reasonable, right? It was only 20p. Before that, the P was only 12, right, or 14. Now, why the P rise here? Because the price earning formula is it is the price divided by earning. So, what was the market capitalization? Market capitalization was 800 crore. When the net profit was 100 crores, right, or maybe 80 crores, the P was around 10. When the net profit got down to around 40, the P basically increased to 20. So, the P increased not because the price was up, the P increased because the earnings fell down, right? So in this scenario, you have to look at the forward P. The forward P means that when what will happen if this 40 crore become 100 crore again, the P again will come back to 8, right? And if the company which is having a 800 crore market cap, posting a sales of around 1200 crores, look at the operating profit margins that the company had. The company had around 10 to a 10% operating profit margin. It is a very good margin percentage, right? No, not even this year. Let me check it in 2015. This was 10% even in 2015, and it fell to 5%, right? Due to temporary reasons or whatever reasons. I think we can go back and check the reasons, what were those reasons. But I am not saying that go and invest in 2016. You wait for quarter on quarter improvement. Like this March 2017 improvement, you would have started seeing that in March, June, September, right? So there would have been a sufficient time to accumulate the stock at this point of time. So you see, this looks like a similar structure even at this point of time, right? This is 2016. So it was a clear opportunity to basically gain around 200% returns here. But what happened after that, right, will amaze you. In the COVID period, right? This is what I tell you, that when the euphoria phase happen, the stock can become 5x, 7x, 10x here, right? So that is why you should not be booking the entire profit at 200% gains. You should try to always leave, some part invested, because you never know if the stock is undervalued, if the stock is only like within 1,000, 2,000, 3,000 crore market cap and it's posting that good numbers, what happens is at this point of time, the PE expansion happens. At this point of time, some big investor like Vijay Kedia entered here, right? And made massive money, right? And then what happened? Again, this sell-off, happened here. Now there were multiple reasons for that. One, definitely, these big spikes are due to profit booking, because someone who made around 10x money in Web of Global from 200, from 150 to around 1,000. These guys basically, these big red spikes are due to the profit booking that they do. And then what happened after that is that again Web of Global started seeing some slowdown in sales and margins, which is now improving, right? If you go and look at their sales data, so you see their sales somewhere in November 21, they started going down. But the sales are again basically going up at this point of time. But the net profits are yet to catch up, right? So they have started catching up, but they are still not to their original historical levels of 2020, right? So what we are basically saying is that the stock has got beaten down so much that it fell here, then here, then here, then again the stock went to 500 in January 24. The price is again here. So this is not like the stock is now continuously falling. Now it is forming a base, right? It is consolidating somewhere in this range. So what we basically did was we tried to identify the range, right? In the process of identifying the range earlier, we were not sure of the fell off can be massive here. So we picked somewhere around this 380 to 330 range. Although this range is also equivalent possible, like this particular range is the next support range, which is 270 to 320, right? And which is what is happening right now. So this support range was not accurate, but this range likely looks accurate, because every time the stock goes to 290, 280, the stock again bounces off from here. So again, it doesn't matter, right? To be honest, the stock is uh, I mean, it will test your patience for some point of time. But if you go and look at the stakes that Vijay Kedia still has, right? This guy is holding around how much? 2% stake in the company of 5,000 crore market cap, which means this guy has invested around 100 crores in this company, has increased his stake also, right, in recent times. So these guys, do a lot of research, right, and they're patient enough to sit on loss also, right. That is the kind of attitude that we also, should develop right here. I mean, I can tell you more reasons about, what I find about Weber Global, but these are good enough reasons, right, for you to think about that. Okay, the sales are improving, the margins are improving. What can happen in future is that at least the stock price will go back to where it was, right? Like people were willing to basically pay this price for the same fundamentals, but now the fundamentals are getting better or maybe going back to the same levels. Why can't I expect the same appreciation now, right? But what can happen after that, right? Again, after that, maybe some consolidation happens. And from here, because Vijay Kedia, who is invested at 300 level, these guys, usually don't sit for 2x or 3x gains. These guys wait for at least 5x, 6x gains, right? So from 300, a 5x gains take to 2000, right? So that is why we think that Web of Global at least can go up to 1500, 2000 also, right? In the next 3, 4, 5 years, right? And suppose that if you're getting 6x, 7x gains in the 4, 5 years, that is a massive 40, 50% CAGR, right? From a single trade. All you need to do is show some patience out there. So we basically, there are a lot of factors on which we bank our selection on, right? I hope this Weber Global part is clear. Like what were the reasons we picked it up, right, and how we picked it up. Uh, Now coming back to SBI cards and Yes Bank, but before that, any questions till this point of time? And we'll try to wrap it up quickly because I know that we are past time and you guys might have some commitments as well. So thanks for holding up for long. But any questions till this point of time? I know that we had to cover a lot of stocks, right, in our list, and due to some reason we're not able to cover that. I'll try to see if we can have another session there, right? Because we have just talked about the jewelry segment, restaurant segment. Similarly, the finance segment itself right now is going through some consolidation for some time, right? Like SBI cards is a pretty growing business, right? uh, the credit card penetration is pretty low in India, right? And what is happening in SBI cards is just look at the valuations, right? The stock IPO came in around what 2020 or 21, right? The price to book value at that point of time was what 15, right? And you see where is it is now? It is only 5, right? And the P ratio has come down to 30. Like it was around 113, right? Like people were willing to pay 100 times the earnings in 2010, right? Because the stock price went from 600 to what 1100, 1200 here. And now what is the company doing, right? The company has posted the highest ever sales. Maybe the 2 quarters are not that good, but it's still pretty a good performance, right? The earnings basically are constantly increasing, just leave aside the 1 or 2 quarter here and there. That is also affected due to the interest rate cycle that we are going through, right? So the fundamentals are improving, right? The stock price is going down. The price to book value is a very important metric, right? Always try to pick stocks where the stocks are now available at historical low price to book values, right? Let me show you an example of Lux Industries, right? So Lux Industries was going through similar problem, right? The entire textile space was going through problems. The price to book value, kept falling up to this level, right? It was around 16, right? Like what price to book value means is that, say if you have a shop of certain cost, you have certain stuff that you're selling, suppose that cost is 50 lakh, but someone in market comes and say that, I'm going to pay you 5 crore for your shop. So that is like 10 times price to book value, right? So the overall net worth of the company or the shop is 50 lakhs, but you're going to pay 10 times that net worth, right? So you have to give very good reasons about, what is the reason that you want to pay 10 times, that price to book value. And you also have to look at the price to book value from sector to sector. In certain sectors, the price to book value can be in the range of 2 times, 3 times, 4 times. But in the IT stocks, you will see the price to book value usually high. The average number is around 5 plus, right? So you have to compare the price to book value at historical levels within the stock past performance itself, right? So from that perspective, it is from 16 to only 3, right, at this point of time. And you see what happened in Lux Industry, right? The stock was consolidating for a long period of time, and that is what I was showing that, we basically gave recommendation somewhere in March 23 to buy in the range of 1100 to 1300. The stock, even fell below that. It went up to 1030, 40, right? Again, like Wabo Global is doing the same thing. And you see where the stock price is right now, right? It gave around 100% returns in only 3 months. And we are not sitting for 100% gains, but we are sitting for maybe this 275% gains. And maybe Lux Industry will not sit here, right? It can, because the stock has not performed for around 5, 6 years, right? It is still at the same levels at 2018 price, right? The stock price has potential to go probably 7x, 8x, 10x from this levels, right? You may end up seeing Lux Industry price as 10,000 in next 5 to 6 years also, right? So that is how big institution investors who have a lot of patience, to sit on stocks, they identify themes that have not worked for long, and then they are comfortably fine holding that stock for more than 3 years, 5 years, 7 years also, right? So SBI cards is also doing the same thing. The stock is consolidating, but it has potential to go easily up to 2,000 price. Now the market cap is around 70,000 crore of SBI card, right? So it's not a mid cap or small cap stock. It's a large cap stock, right? So don't expect too aggressive moves like a 10x returns from SBI card. So you have to expect reasonable returns also. The Yes Bank is more of a turnaround story, right? What is happening in Yes Bank, we all know, right? What happened here? The stock fell from 400 to around the levels of just only what I think 12 or so, and then there is huge consolidation that has happened. there are these big volumes, right, where people were accumulating stocks, right? So they were not accumulating for no reason, right? So they were accumulating because Yes Bank started showing improvement in sales, right? So the sales are improving here, right? And if you look at the overall net profits, right? So comparing from 2022, there was a drop here, and then we are again going back to good improving levels, right? We are going back to the levels which were there probably earlier in 2018 also, right? When the stock was at peak price of 400, right? So I'm not expecting Yes Bank to become 400 here, but there are very strong reasons for Yes Bank to at least become 2x, 3x, right? To at least reach up to this level in next 3 to 4 years. Sorry, this level first, which is the price of 70 to 80, right? So you have to take baby steps in Yes Bank, right? See if the bank continues to improve its performance. So from this to this level, the 200% gains will be there. Then we'll again check the story. If the story looks good, probably we can keep some part invested, and then you can wait until this 170 levels, then this level. So the typical turnaround story play can take up to around 7 to 8 years, right? From this level, like May 28 is when you can see the stock, going back to its previous high, which is like around 4 to 5 years from now, right? So Yes Bank is a story which will keep on incrementally playing if the bank continues to do well. Yeah, so that's the reason for Yes Bank. Uh, any more specific stock specific question in the smile list? Uh, yeah, so overall, I know we could not get time to cover all these stocks, but at least the process was pretty important, right? To understand what things that we look into, picking the stocks. Why we don't look into picking the hot themes or hot stocks, because, it is a lot of value in picking stocks that have proven their performance in the past, suffering through some bad reasons, and then, when those things are improving, then there is a sure confidence, in the price again reaching back to those levels. And especially when you are managing advisory, and you have a lot of clients, you basically have to decide according to their risk and everything, right? So all these things are very important. Uh, so I stopped probably presenting here, and maybe for one last time you all guys can come on video. I can take a picture of this, right, so that we can use it uh, to probably put it on our Twitter account, for uh, promotions and whatnot, because it's another thing that we have to do, right? We are doing good work, but until you highlight the specific work, it's very difficult, right, to get the or gain the right traction. So maybe once all of you, if you can come on video, would appreciate. Nitin, Abhishek, Rajshekhar, Sohan. Okay. Hey Nitin, hi. Sohan, you coming? Or I'll take the picture. Okay, let me just take the snapshot from here. Oh, you don't have a webcam. That's okay. No worries. Anyways, any final doubts or anything that you want to? When I leave the stage to you guys, like I've spoken enough. Anything that very quickly you want to touch, like uh, want to talk about the process that we are having, like you find value with that, the updates that we share, any feedback that you want to give, not the positive side, even the negative side, things that we can improve, right? Just let us know, right?